All right, let's get straight to it. Today, we're diving into the Q1 2025 financial results for Advance Auto Parts.
Released May 22nd, right?
That's the one. And we've got a few things to work with here: the earnings presentation, the release itself, an AI summary of the call, and a performance infographic, too.
Okay, quite a bit to unpack. So the mission.
Pretty much cut through the noise, extract the key insights from all this material, without getting bogged down in jargon.
Sounds good. So let's kick off with the headline. What was the big takeaway from the top-level results?
Well, the main thing is that Advance Auto Parts actually did better than expected on both sales and profitability in Q1.
Okay, better than expected.
Yeah, and the CEO, Shane O'Kelly, he sounded pretty positive. He specifically highlighted the pro segment bouncing back.
The professional side.
Exactly. 8 straight weeks of positive comparable sales growth in the U.S. for pro. That's quite a run.
That is notable. Anything else jump out?
Well, yeah, and this is interesting. They reaffirmed their full-year guidance for 2025.
Okay, despite headwinds.
Right, despite mentioning new tariffs and what they called a highly dynamic economic environment.
Reaffirming guidance with those factors in play. That suggests some confidence, doesn't it?
It certainly seems that way. Maybe their strategy is paying off or they have good visibility.
Let's dig into the numbers then. What did net sales look like?
So net sales landed at $2.6 billion,
Okay.
which is actually down 6.8% compared to last year's $2.8 billion.
A 6.8% drop. What's driving that?
It's primarily their store optimization program. They closed quite a few locations, over 500 actually.
Right. So that's a big factor. With those closures factored out, what about comparable store sales, the stores that stayed open?
Good question. Comparable store sales saw a much smaller decrease, just 0.6% year over year.
Okay, minus 0.6%. That gives a better sense of the underlying trend for the core business.
Exactly. It filters out the noise from those closures.
And how did this impact profitability? Let's start with gross profit.
Gross profit came in at $1.1 billion. That works out to 42.9% of net sales.
And how does that compare to last year?
It's down from $1.2 billion, which was 43.4% of sales. So the margin compressed a bit.
Any specific reasons cited for that compression?
Yeah, they pointed to about a 90 basis point headwind, almost a full percentage point, just from the liquidation sales at those closing stores.
Makes sense. Selling off inventory cheap hurts margins. What about operating expenses? SG&A.
Right, SG&A. It was $1.2 billion, or 48.0% of net sales.
Wow, 48%. How does that compare?
It's up significantly as a percentage from 41.5% last year, though the dollar amount was similar. On an adjusted basis, it was $1.1 billion, or 43.2% of sales versus 41.4% last year.
So costs are taking up a bigger slice of the revenue pie. Any particular drivers?
They mainly pointed to higher labor-related expenses, causing that deleverage against the lower sales.
Okay, higher operating costs, slightly lower comparable sales.
Yeah.
How did that shake out for operating income?
Well, it resulted in an operating loss, $131 million, which is 5.1% of net sales.
A loss compared to what last year?
Compared to an operating income of $53 million, or 1.9% of sales last year. So quite a swing.
That is a big swing. What about on an adjusted basis?
The adjusted operating loss was smaller, $8 million, or 0.3% of net sales, still down from an adjusted operating income of $56 million, or 2.0% last year.
And did those liquidation sales impact the adjusted figure too?
Yes, they mentioned that same 90 basis point negative impact from liquidation hit the adjusted operating margin as well.
Okay, so we're clearly seeing the financial impact of these strategic shifts. How did all this affect their cash flow for the quarter?
They actually used cash in operations, $156 million used, compared to only $3 million used in Q1 last year.
A much bigger cash outflow and free cash flow.
That was also negative $198 million versus negative $49 million the year before.
Why the bigger drain on cash?
They explained it includes about $90 million in cash expenses tied directly to the store optimization.
Okay.
And another $100 million invested in inventory for their new assortment framework.
Got it. Significant cash needed for these strategic moves. Let's pivot to those strategies then. How's the progress looking?
Well, first off, the store footprint optimization, the closures, they actually finished that ahead of schedule.
That's efficient.
Yeah, and they estimate about 75% of the remaining stores are now in markets where they're number 1 or number 2 based on store density.
Sounds like a more focused geographic strategy. Smart.
It does seem that way.
And are they just shrinking, or is there a growth plan too?
No, definitely planning growth. They aim to open over 100 new stores in the next 3 years.
Okay.
And they even hinted they might accelerate that pace. So closures now, but growth planned for the future.
Interesting balance. What about inside the stores? Merchandising.
Big news there. They've accelerated the rollout of their new assortment framework.
The one they've been talking about.
Exactly. It was already in 11 DMAs by the end of Q1. Remember, the original plan was top 50 DMAs by the end of fiscal 26.
Right.
Now they're shooting for the end of this year, 2025, and hoping to have 30 DMAs done by August.
Wow, that's a big acceleration. Is it working?
Seems like it. They estimate almost a 50 basis point lift in comparable sales in those first 11 DMAs during the initial 9 weeks.
0.5% lift just from the new assortment. That's promising.
It really is an encouraging early sign.
Do we know what kind of products in that assortment are driving it?
The sources didn't break it down that far, unfortunately, but the acceleration itself suggests they're seeing positive results across the board.
Fair point. What other strategic areas are they focused on? Supply chain.
Yep, supply chain is key. They saw improvement there. Product lines picked per hour in the DCs improved by a low single-digit percentage compared to last year.
Incremental gains.
Exactly.
Yeah.
And they're still on track with the plan to consolidate down to 12 large distribution centers by the end of 2026.
Okay.
Plus, they've opened 2 new market hub locations, greenfield ones, and they're aiming for 10 total this fiscal year.
And are those hubs boosting sales?
Apparently so. They estimate nearly a 100 basis point, a full percentage point, comparable sales uplift for those market hubs and the stores they serve.
Okay, so supply chain and merchandising seem to be showing positive signs.
Yeah.
What about actual store operations and the customer experience?
Making progress there, too. We already mentioned the Pro segment's 8 weeks of positive comps.
Right.
They've also cut average delivery times by about 10 minutes year over year. That's significant for Pro customers.
Definitely.
And they're testing a new standardized operating model in over 10% of their stores.
Standardizing operations.
Seems like it. Also, interesting note, units per transaction in the retail or DIY segment have stabilized, maybe bottoming out.
Potentially. Any marketing efforts?
Yeah, they launched a new campaign right around the corner and ready to help.
Catchy.
And maybe it's working. Their time to serve metric, how long it takes to help a customer, is down to about 40 minutes.
From what?
From over 50 minutes on average last year. Their target is 30-40 minutes, so they're hitting the upper end of that target now.
Okay, lots of moving parts, lots of initiatives. Let's go back to the guidance they reaffirmed for the full year 2025. Remind us of the key targets.
Sure. Net sales, $8.4 billion to $8.6 billion. That includes a bump of maybe $100 to $120 million from the 53rd week this year.
Okay, comp sales.
Comparable store sales, for the 52 weeks, they expect positive 0.50% to 1.50%.
So growth for the year.
Yeah, but they expect it to ramp up stronger in the second half.
And margins.
Adjusted operating income margin target is 2.00% to 3.00%. They specifically said gross margin will be the main driver there.
Makes sense after the Q1 hit. EPS.
Adjusted diluted EPS forecast is $1.50 to $2.50. That range includes about $0.40 from interest income and a nickel or so from that 53rd week.
Right, investments.
Capital expenditures around $300 million.
Right.
And free cash flow is still projected to be negative, between $85 million and negative $25 million.
Still negative FCF.
Yeah, but that includes roughly $150 million in cash expenses for all the store and DC optimization stuff throughout the year.
Ah, okay. And new store plans for the year.
Plan is for 30 new stores and those 10 new market hubs we mentioned.
Okay, so despite the Q1 results being a bit mixed with the loss, the full-year outlook is still intact. What are the big clouds on the horizon? Challenges.
Tariffs are definitely one. They mentioned that highly dynamic economic environment and called tariffs a key risk.
How are they planning to deal with those?
Sort of a three-pronged approach. Push back on supplier cost increases,
Yeah.
look for alternative sourcing, and then, if necessary, pass the rest through in pricing.
The classic playbook. Any other pressures?
Yeah, continued pressure on the DIY side. The thinking is, potential consumer goods, inflation might be squeezing household budgets.
So DIY might remain soft. What are analysts watching closely?
Unsurprisingly, the focus is on whether they can really sustain improvements in gross margin and how successful they'll be in getting those procurement cost savings. That's key to hitting the guidance.
Right, the execution risk. Let's quickly touch on the store count changes again. What were the final numbers for Q1?
Okay, so as of April 19th, they had 4,285 stores total. That's 4,050 Advance Auto Parts branded stores and 235 CarQuest ones.
And the net change in Q1.
They opened 10 new stores, 9 AEP, 1 CarQuest. But they closed 513 466 AAP 47 CarQuest.
Wow, so a net reduction of 503 stores in just one quarter. That's the optimization program in action.
Absolutely, a major reshaping of their footprint.
One last detail, any dividend news?
Yep, standard stuff. They declare their regular quarterly cash dividend due enters 25 cents per share.
When's that payable?
Declared May 13th, payable July 25th, to shareholders on record as of July 11th.
Okay, standard dividend procedure. So let's try and wrap this up. Key takeaways.
I'd say Advance Auto Parts beat expectations in Q1, mainly on profitability. They're pushing ahead hard with their strategic plan, store optimization done, merchandising rollout accelerated.
And they're sticking to their full-year guidance despite acknowledging challenges like tariffs and a potentially soft DIY market.
Exactly. The progress on the pro side and the early results from the new assortment framework seem to be giving them confidence.
The potential for future growth seems tied to making those new stores work and getting that assortment rolled out effectively.
Definitely. Which brings us to our final thought for you, the listener.
Considering their focus on the pro segment and the challenges they admit facing in DIY, what else could Advance Auto Parts do long-term to really capture and keep that DIY customer?
Yeah, and also, how will that shifting tariff situation continue to impact them? Will their mitigation strategies be enough? Something to mull over?